Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full.
We're going from an era of abundance, driven by a huge capital boom 10 years prior in the shales. That brought on the abundance. That led to low prices. That led to a dearth of capital or a lack of capital, which is now having a supply response. That's the commodity cycle. And I think we're in the process of inflecting towards a major bull move.
Adam, I would like to now turn to natural gas if we could. This is a fascinating story. So for everybody listening, we're talking with Adam Rosenzweig of Gehring and Rosenzweig and discussing their most recent quarterly report. And now, can we talk natural gas for just a sec? So, hey, here's, 2022, again, that famous period. We saw natural gas 6, 7, 8, 9, even touching 10 briefly. This is weather in the yellow here. This is the behavior of natural gas in the U.S. since the war started, which is here in March. It's down. So not much going on there. And, of course, we can see just nothing but lots of demand. These are in billions of cubic feet per day. And this is, again, from your report, pulled from the EIA. Look at all these LNG plants coming online. It's about 13 BCF by 2030 additional. So it's about 4 BCF per year, give or take. So just holding that 4 number in line. And I read stuff like this every day. So Gaurav Chakrabarty was pointing out that Chevron is now going to sell natural gas not to chemical plants. They're building a 5 gigawatt. A 5 gigawatt. That's like 5 Denvers of demand. 5 gigawatt gas power plant for Microsoft. So I ran the numbers, and it turns out that one plant for Microsoft is going to consume about 0.75% of current daily marketed dry gas production. It's about somewhere in the vicinity of 0.8 BCF per day. And there's data centers going in all over the place. So we have LNG terminals. We've got this demand. My question is anybody adding this up? Because it feels like there's a problem here. And when you point out where our shale gas growth has been since 2023, it's, again, the Permian more than making up for all other shales. And actually, when you sum them, you get to pretty close to flat on the past year, don't you?
Yeah, you do. And, the Permian is going through what we call this gas burp, which means is the Permian, the Permian's not purely unique, but a little bit different in terms of a gas field. It produces oil and gas commingled together. And as any given well in the Permian gets older, it's going to produce more gas relative to oil compared to how it started out. It's going to get gassier. And eventually the pressure lessens so much that the gas and the oil actually separate, like a can of soda after you've opened it or a bottle of beer. And the gas, when it's sealed under pressure, the gas is dissolved in the liquid, and when you release the pressure, they begin to separate and one flows. And so eventually, as these wells get older and the pressure comes down, you flow gas preferentially. Towards the end, it gets gassier. Now, when the Permian was growing, its wells, on average, were getting younger. The production-weighted average age of a well was getting younger as you drilled more and more and more. That's now begun to change because the field and on its oil side of things has basically kind of plateaued, right? And it looks like it's turning negative year on year, which means the wells are getting older and older and gassier and gassier. So you get this big kind of gas rush out of the Permian. Is that meaningful, impactful? I mean, it is, but it's also a bit of a swan song. It's telling you the field's getting awfully old, and most importantly, it does not go on forever. And so when does it actually start to roll over entirely? Is it this year or next year? My guess is probably the end of this year, beginning part of next year, and take that with a grain of salt because I can tend to be a little bit early on things. So I think the Permian is going to sort of have this wake-up moment within the next 2 years, let's say that for certain. In the meantime, the rest of the shales are all declining, relatively sharply. Even the Marcellus has been now flat for about 3 years, and we're going gangbusters on our exports. Absolutely gangbusters. So what gives? Why are prices stuck where they are today? 20% of LNG is now also trapped in the Strait of Hormuz, and we're having major problems with gas supplies around the world. And frankly, the reason that we're not seeing an impact in the U.S. is that the export terminals were full in January before Strait closure, and they're full now. So we're just exporting, right? Someone's taking advantage of that huge discrepancy, but it's not like we can respond and push more gas out of the country to make up for the lost volumes in the Strait. So we're still pooling gas back in the United States. We had more or less a normal winter. On a normal winter, we took inventories down. That tells me that we're in a structural deficit in gas prices, right? If you have normal weather and inventories stay flat, seasonally adjusted, that would tell me we're balanced. If you have normal weather and they build, that tells me you're in surplus. And if you have normal weather and they draw, it tells me you're in deficit. So I think we're in deficit. We had a normal winter, and inventories went from well above average back down to average. They're still not at dangerously low levels by any stretch of the imagination, but we've worked off a lot of that overhang. And I think the path forward, it's going to continue to be one, I think, of convergence between the U.S. price and global price, which could be multiples of where we see it today. This has been a very frustrating trade for us. It's taken a lot longer, mostly subject to weather disappointments, and then a little bit to some stubborn production that's taken a bit longer to slow and roll over than we would have expected. But still, you're not seeing fabulous growth anywhere outside of the Permian because of the reasons that we just talked about. So to answer your question, or what are they thinking, and are they adding up the numbers? I think the short answer is no, they're not. And before you call, I'm not saying before one calls anybody, names and say, how could they be so foolish? You have to appreciate the huge magnitude of what the shales did in gas. In many ways, the disruption to the U.S. gas market from shale gas was far greater than shale oil. We brought on 95 plus billion cubic feet per day of new gas from shale. Divide that by 6, and that's your oil equivalent. You're talking 18-ish million barrels, 16 million barrels of oil equivalent, far in excess of what we brought on the actual oil side. And we threw the kitchen sink at this thing. We converted a lot of our coal plants to gas. We built all this petrochemical industry. We built a huge export business. We laid down already a lot of data centers and fertilizer plants, and we've still been able to produce more than we've needed. So on some level, I suppose I can empathize with the developer, whether it's a data center developer, a pipeline developer, what have you, that kind of says, look, I think the gas, we have it in hand, but maybe I'm being too kind because it ultimately is a really, really big blind spot. When you talk to these guys, no, they don't care. I mean, that's the short answer. They say we worry about a lot of things, we don't worry about the gas. Go to Europe. It's a totally different story. Everyone's worried about the gas because, first they had their disrupted supplies from Russia. They had to go to the LNG market to buy it. Now a bunch of the LNG in the world is tied up in the Strait of Hormuz. So Asia's bidding that desperately away. And, finding molecules of energy in Europe is challenging, and you feel it. When you talk to the people, they feel it. We in America tend to be focused at the prices, about the price at the pump. I think very much the American psyche is tied around that gasoline price, and they don't have any idea what natural gas costs. And I don't think that will last for very long.
Now, when I look at the EIA's projections, they merely show us going from, I'm rounding here, about 100 BCF up to 150 by 2050. Where's that gas coming from in their minds?
Look, again, I just don't see it, because if you look at shale gas fields, we're going to take away the ones that are growing, but let's just look at the bulk of them in numbers. Most of them have peaked and rolled over and done so quite violently. The Barnett is down 50%, the Fayetteville down 60% or so, the Marcellus down, now peaked for 3 years. Some people say it just needs more pipelines, but we added a big pipeline last year. We didn't get a huge upsurge in volumes. It's again sort of just flat through that. So I think it's making this big prolonged kind of top before it too begins to roll over. Will it come from the Utica? People have been trying at the Utica for a while now. Do they get results? Yeah, there's some results. But when you start to lose really prolific fields and you backfill them with more challenging fields, that's never the recipe for new highs. You need to get a new field that is on par with the Marcellus and the Permian to replace the Marcellus and the Permian if you want to start to see any material growth. And again, just like the shale oil, I don't see where that will come from. There's some opportunities in Canada. And look, I debated Doomberg, who's an energy analyst on Substack, a couple years ago, and it was more of a semantic fight, honestly, than it was a true intellectual debate. Because, at a certain point, he said, well, in 10 years' time, do you think we're going to consume more oil or less? And trying to say, do you think the world economy will be greater or smaller? I think it'll be greater. I think we'll consume more, which, of course, means we have to be producing more. So, this is not sort of a Malthusian call that we're running out of everything and we're going to have to sort of shut the lights off. What it means is that easily dispatched unit of marginal growth becomes harder and harder to find, and that's what resets prices higher. So where will it come from? I'm sure your viewers and listeners will post in their comments a list of fields that it will come from. I'm sure it will. My point is, we're going from an era of abundance driven by a huge capital boom 10 years prior in the shales. That brought on the abundance. That led to low prices. That led to a dearth of capital or a lack of capital, which is now having a supply response. That's the commodity cycle. And I think we're in the process of inflecting towards a major bull move.
Understood. And just to really clarify this for people, when we say the Permian, it's actually three formations in the Permian that we're down to: the Wolfcamp, the Bone Spring, and the Strawberry. All others are just that little blue smear at the top. Really, the Wolfcamp's doing the heavy lifting on this whole thing. So again, some people look at this and say, wow, look at all that gas growth. We'll just keep growing that forever. But what you said before is this is actually indicative of a shale play that's starting to bubble out.
I think that's right. And it's very funny because a number of years ago, Pioneer Natural Resources, which was a big Permian producer later acquired by Exxon, they had a single quarter where their gas to oil ratio went up. And I was astonished at how many people came out of the woodwork talking about bubble points and gas oil ratios and retrograde condensate. And we really thought it was a fairly esoteric, in the weeds kind of technical thing. Everybody became consumed with that, and they used it as an excuse to sell off their Pioneer or go actively short. And of course, that kind of worked itself out. This is years ago. The field was not depleting yet. And we wrote at the time that I don't think this is a problem because the field's not depleting, and the GOR issues, you should expect to see them down the line. So that was sort of a false start, for the bubble point people. And we never thought that was a issue then, but I think it is now. I think it is because if you look at the total recoverable reserves, the way we estimate them, which is a bit of an art and a bit of a science, we're much farther along clearly in the life of that play. By definition, I guess every day you're a day older, but I think we can make anyway a very credible claim that you are now at a point in time that you should expect to see a bubbling out, as you put it, and sure enough, you're seeing that. So again, that's not the sign of a healthy young field in growth. What it really is it's sort of the swan song. It's the your old granny getting a burst of energy sort of right before she croaks. Not to be too crude.
Today's markets are more volatile than ever. With ongoing economic and geopolitical uncertainty, navigating such environments requires thoughtful, adaptive strategies, not a one-size-fits-all approach. At Peak Financial Investing, our registered investment advisory firm connects clients with experienced wealth managers who focus on active portfolio management. These professionals use evidence-based strategies designed to respond to changing conditions, not outdated formulas, but customized approaches grounded in research, discipline, and risk awareness. We believe in open, informed conversations, including discussing tools like precious metals and diversification as part of a broader financial strategy. Every investor situation is unique, and our advisors tailor their guidance accordingly. Visit peakfinancialinvesting.com today to schedule your free consultation and explore how proactive management can support your financial goals. I'm Dr. Chris Martinson, proud to work with Peak Financial Investing, and and my support reflects my professional views. I encourage you to take control of your financial future by making informed decisions. The wild card for me in this is the data centers, because it's just all anecdotes. I mean, I have to pull individual reports. I can't find anybody who's aggregating this at either the state or national levels.
I agree.
So I read about a big data center in Texas and one in Illinois, so I start mentally adding them up. But with that one Microsoft one I mentioned at 0.75%, if you had 100 of those, you're consuming 75%, right? So obviously we're not going to have 100 data centers of that magnitude, but there are thousands of data centers going in, which are largely the natural gas, whether they burn it themselves or they tap into an electric grid that's burning it. They're making a demand call on natural gas.
Oh, absolutely. No two ways about it. And, a lot of these tech companies are talking about nuclear to power their data centers, but that's not going to be until the 2030s. And so to the extent that they want to have growth now, which they all, of course, do, you need gas to bridge it, or coal. Coal could do it, too. I don't think there's a big appetite for that. I think certainly you would prefer to burn the gas that seems to be today readily available, abundant, and cheap, right? And clean. It's not going to be renewables. It cannot be, for a variety of reasons we probably don't have time to get into here, but it will be natural gas will be the huge beneficiary. And like you said, it's either going to be off the grid or behind the meter, which means, co-located on site. Completely irrelevant from a gas perspective, whether you go through a regulated utility, gas molecule, as it's being burned and spinning a CCGT turbine, doesn't care if it's behind the meter or in front of the meter one bit. And so, it's a massive, massive number. Now, to your point, nobody knows where any of this stuff is going to settle out. And I wouldn't, necessarily want to make a gas bet predicated only on data centers, but you don't have to. The market is relatively tight today. Again, inventories have come down. They're not at dangerous levels, but relative to averages, they've come way, way down on fairly normal weather. Prices sold off, by the way. You had that chart up before, about a 12-month period they sold off because it had a very mild end of February, March, very, very mild and benign. Cold enough that air conditioning demand didn't kick in, and warm enough that heating demand wasn't necessary. It was quite a lovely period, but not great for gas demand. And so, of course, weather will always remain the wild card, but on normal weather, I think you just keep tightening this market. You keep tightening it, and it is probably on a percent move, from here, right, with gas sub $3. Could it get to 10? It's going to get to 10 before oil gets to 300. I think that's for sure.
Well, I'm going to continue to watch the flat production like a hawk, because if it stays flat, I'm just going to be like, well, it's staying flat for some reasons, and the reason is probably because we're not producing more. And is that just a shortage of drill rigs, takeaway capacity, or is it that things are rolling over, and the gains out of the Permian are no longer keeping pace with the losses from other areas? Don't know. But I see a setup here that's exceedingly bullish when we look at all the calls on demand.
I do as well. And sorry, just one thing that I'll say just quickly. It's hard sometimes for people, and myself and anybody, to think in terms of exponential decays and differential equations. And that's really what you're working on here, because you have a well that comes on, that well begins to decay exponentially almost at once. Then you have every well comes on is a little bit less productive than the one that came on before it. You have wells that are getting older, so getting gassier, but getting less productive in general. And so it's all these kind of opposing forces all operating in exponential space, not in linear space, and it's really hard to kind of wrap your head around it. But it turns out it's actually quite straightforward to model on Excel or on a computer program. And what it suggests is that you're getting awfully close to this period where gas supply in general will stop growing, and demand is just going gangbusters. It's just going gangbusters, and so. Yeah, that sets up for the market that we love to get involved in, one that's been completely starved of capital, one that has a narrative, a bearish narrative embedded in it. In this case, I would say it's best summed up by the Doomberg adage of sort of we have an unlimited amount of gas, and on the way up, unlimited growth feels like it's unlimited as it's growing. It's not until it stops growing that it feels awfully difficult to come by. And when you can find areas like that, starve for capital, based around a bearish narrative that's ultimately incorrect, and the fundamentals are about to turn, I mean, if you can just really lean into that, you can make a huge amount there's a huge amount of value. And that's what we try our best to focus on. And sometimes the calls can be stubborn, but usually over the long term, they can be very, very fruitful.
Everyone, we've been talking with Adam Rosenschwag of Gehring and Rosenschwag. Go to GoRosen, GOROZEN.com, to find their quarterly missives. They are must-reads. I never miss them. They're thoughtful and thought-provoking. And so, Adam, thank you so much for your time today. Is there anything else you would like to direct people to?
No, I think that's it. I think just to reiterate, I think we're in the early stages here of a bull market. Out of all the commodities people talk about, we get asked, do we miss it, et cetera. 3 commodities made new nominal highs. 1 made a new real high, and that's gold. The other 46 are still below their past nominal peaks and well below their real peaks. So, look, flows of funds into the industry have been anemic. Even in gold, frankly, has been anemic into gold miners. But I think that we are very early days across most commodities here. Maybe with the exception of gold, I think that could trade sideways for a while. But most of the other ones look awfully bullish to us, and I think there's going to be a huge opportunity for investors that decide to make their moves now.
Excellent. Well, Adam, thanks again. Really appreciate your time and knowledge on all of this.
Thank you.